in this order book, but you can see we can choose the price that we pay, we can choose the amount that we buy, and then we know exactly what our order is before it goes through, because the system can just times the amount by the price per Bitcoin that we're trading. Also important to note that 55,300, we always quote in one whole Bitcoin or one whole asset. So it's not 55,300 for half a Bitcoin, it's 55,300 for one Bitcoin, and then you are only trading 0.05. And so you can see it does that calculation for you. Once you press buy, you will not trade straight away. We cannot trade straight away because our price that we want to buy at is lower than sellers are willing to trade at. So what happens, it comes down here. It will go in your open orders. You'll see it, it's there, the system knows it's there. And if the price and sellers come in and are willing to sell at that price, then you will go ahead and trade. Next, we come to stop market orders. With the stop market order, you choose the amount that you trade, but you don't choose the price that you pay or get. For cryptocurrency, the price isn't guaranteed. Remember, the word here, market, is the giveaway. Market means we do not choose the price. But with a stop market order, we can actually choose the price when the order is placed in the market. So it's a slightly different way. Now, some strategies will need this order for maybe their stop losses or maybe to buy on breakouts. So you can see it's good for fast trading and it gives you a slightly different way of trading. So with a stop market order, you're telling the system that if the price gets to a certain level, enter a market order for you to either buy or sell. If the price gets to 57,500, sell my Bitcoin with a market order. You can see the price right now is 58,209. Why would you want to sell at 57,500? Well, look, if the price is going down, which it is here, you can just say, look, the price is going down. I'm losing loads of money. I need to get out of this position and stop losing more money. If the price gets down to a certain level where I'm happy to take that risk, if it actually gets down there, then put a market order in and sell my Bitcoin straight away and stop any further losses. You can see if the price gets down here to 57.5, the system will input for you a market order and just sell out your Bitcoin. Using what we know about market and limit orders, a stop limit order then is an order where you can choose the amount and the price that you trade. Traders will use stop limit orders to add onto a winning trade a specific price level. So a stop limit order can actually be placed in different areas, and it tells the system if the price gets to a certain level, then you want to go ahead and put a limit order in. So again, the same example, let's say the price gets down to 57,500, so we're making a loss. You can say sell my Bitcoin with a limit order, not a market order. Remember, a market order, we're not guaranteed a price. We're going to get the best price in the market at that time. With a limit order, we're guaranteed to trade at 57,500, and if there is no liquidity at that price, we may not get our whole order traded. Let's come on to a stop loss order then, which is just a version of a stop limit order, but it stops your losses. So this is important for day trading to mitigate risk. You'll hear people talking about stop loss orders. It's simply an order that you put in and says, if the price gets to this level, then sell my Bitcoin with a limit order. A stop loss order must be below the current price. That's why it's called a stop loss. You're stopping further losses. So if the price gets to 57,500, sell my Bitcoin with either a limit or a market order. But a stop loss is saying I'm going to stop any further losses, and you can use a limit or a market. Doesn't really matter, but it's the same price level. People just call it a stop loss when they're actually coming out of a trade for a loss. It's important to know though, because when you're mitigating your risk when trading, we'll always use something called a stop loss as a backup to know how much our position at risk is. Conversely, a take profit order is a stop limit order, but that makes you money. So we can trade a position in profit, and this is really important for day trading to automate our trading. Again, when we're putting in orders later on in the video, we're going to be using a stop loss and a take profit. They're both the same order. They're a stop market order. We just call them different things when we're talking about losses and when we're talking about gains. If the price gets to 65,000, sell my Bitcoin with a market or a limit order, and you can see it will come up right here. This is known as a take profit because we're actually getting out of the trade with a profit. To show you how to input stop limit orders or stop market orders, let's come back to Binance. It's just over here. Stop limit, we can come in. Now, stop and limit. Stop is the price that you want to tell the system to trade at. So let's say we want to take some profits at a higher price. The current price of Bitcoin is 55,260. So we're going to say at 59,000, I want to enter an order and my limit price is 59,000. What you're telling the system is when the price of Bitcoin gets to 59, enter a limit order for me, and I'm only willing to sell at 59. So 58,999, not going to sell any Bitcoin. I'm actually a buyer right here, just going to switch over to sell to make it easier for you. So stop limit 59,000 and my limit order is 59,000. When the price gets to 59, put in a limit order for me at 59. Now what you can also do is put your limit in at 58. So what you're saying is when the price gets to 59, basically just dump my Bitcoin and I'm willing to take 58. So you're probably going to just deal straight away unless you're dealing trillions of dollars worth. But that is a way to put in actually a take profit order in this case. The price is above. Now, if you wanted to put in a stop loss, what you would do is say, if the price gets to 48,000, that is way below the current price, please put in a limit order for me at 48,000. You can also change this. Maybe your limit is 47,000. Maybe your limit is 50,000. Now, if the order is 50,000, then obviously you're not going to trade. If the price is at 48 and you want to sell at 50, then you're not going to be trading, but that limit order will be in there for you. So you can play around with this stop limit order. You can do it on the buy side as well. Just tell the system what is the trigger for the order. This is the trigger price. 59,000 is the trigger price. This is the order, 59. You can put in the amount, either buy or sell, put your take profit and your stop losses in. So let's recap Unit 6 then. We have many trading options. You can make or take prices. If you put in limit orders, you make liquidity, make prices, you are a maker. And if you enter market orders, then you take liquidity from the book. Makers do get slightly lower trading fees on most trading exchanges than takers. And stop orders can limit our risk and they can also trade us out in winning positions as well. We can use all of these orders at different times as needed. This is probably the most important unit of this whole course, technical analysis. It's a really big unit. We're going to get into some really complex things, but I'm trying to explain them as simply as possible. And we're going to take all of the information that we've got so far, plus all of the technical analysis techniques, and then use them to go ahead and trade in Unit 8.
Magnum Almond is expertly crafted. Velvety ice cream, crunchy almonds, and premium Magnum chocolate. A timeless classic. Magnum, for pleasure seekers.
And then use them to go ahead and trade in Unit 8. In Unit 7, we're going to be looking at chart patterns, what is a trend, how to spot a trend, super important, right? Support and resistance. Again, when you're trading, you have to know these things. We're going to look at how to use candlestick charts and indicators to time our trades. All of this information is what professional traders will use every single day when they are trading in and out of an asset. There's so much information in this unit. It's all linked in the description for you. You need to check the description. All of the resources that I talk about will be in there for you so you can go ahead and learn more. Let's get into it. What is technical analysis? TA, or technical analysis, uses trading data to analyze and predict price patterns. That's obviously important. If we can predict the pattern of a price, we can have a higher percentage win rate for our trades. It gives us data points to compare and contrast, which again tries to increase our chances of winning trades. We can use chart patterns, price data, trading volume, and mathematical equations, otherwise known as indicators, to furnish ourselves with more information. It allows us to follow a systematic strategy that can be improved and iterated upon over time. If you do not follow a consistent strategy and you're using different strategies all the time, how are you ever going to improve it? It cannot predict the future though. Technical analysis cannot predict the future, and it is often wrong. An event will happen, something will happen. A politician in America will say something that the markets don't like. Technical analysis goes out the window, which is why some people love it and some people hate it. At the very basic level though, we need to understand candlestick charts. Candlestick charts give us data-rich trading analysis. They show us time and price details. That's really important, and it's something that line charts don't give you. Let's go ahead and analyze a candlestick then. What exactly is a candlestick? Well, each candle is a period in time. So each candle is representative, and it can be anything you want. It can be 1 minute, 10 minutes, 1 day, even 1 week. But it tells us the open, close, high, and low for the time period of the candlestick. There's two areas to the candlestick. We have the colored in part, which is the body